Good day and welcome. My name is Gerhard Hambusch, and as academic staff in the UTS Finance Department, I welcome you on another beautiful and sunny Wednesday to the Finance Research Showcase at the UTS Business School. First, we hope that all of you are safe and well in your home or city offices. We're excited that so many of you have once again joined us to engage with fresh and relevant finance research developed right here at UTS. If you visit us for the first time, here's what to expect. Today, 3 of our finance researchers will present their latest research each for 5 minutes, followed by an industry member's commentary and finished with your audience questions to be submitted during the event via the chat window. Our industry expert today is Nathan Lim, who is Head of Private Wealth Research at Morgan Stanley's Sydney office, and we thank him for joining us today. Besides working hard for his clients, Nathan is an honorary adjunct professor at the UTS Business School who works with students and researchers on informing research and teaching to foster our mission, which is to serve students and to advance knowledge with impact for the ultimate benefit of society. We are also excited that Professor Michelle Baddeley is joining us today. Professor Baddeley serves as the UTS Business School Associate Dean Research to foster innovation, relevance, and impact of research developed in the business school.
So thank you so much for inviting me to welcome everyone again. I enjoyed the event so much last time, so it's a great honour. Firstly, to welcome Nathan joining us today to give some insight and feedback, and also our 3 speakers, so Kathy Walsh on China's digital currency, Diego Moncay on de facto bank bailouts, and then Anirudh Dhawan on getting burned by frictionless financial markets. So all sound like wonderful topics, and I'm very excited to hear more about those topics because I have an interest in finance myself. And so thank you everyone, and I hope you very much enjoy the next hour. Thank you, Gerhard.
Thank you very much, Professor Baddeley. And we're now ready to start our finance research trip around the world with destinations including topics related to China and the United States. We start with UTS Professor of Finance Kathy Walsh. This research is highly relevant to understand international currency markets, and as such has attracted research funding from the UTS Australia-China Relations Institute.
So my research project here, as Gerhard mentioned, is looking at China's digital currency. It's co-authored with Carly-Ann Richards, also from UTS, and Yolanda Wang from Shenzhen University. I'm quite grateful actually that we have Yolanda on board because most of this research was supposed to be done on the ground in China, and the current COVID restrictions are prohibiting that. So the research is also, as Gerhard mentioned, has been received funding from ACRI, which is the Australia-China Relations Institute. We're very grateful for that. Okay, so the big questions we're looking at are whether or not the digital currency from China is expected to extend to cross-border trade, and if this is the case, are we going to see a shift away from trade settlement in US dollars? So in April this year, China became the first major currency or economy to conduct tests of a central bank currency. And a central bank currency, a digital currency, is quite different to other cryptocurrencies because it's validated by a blockchain that's controlled by the central bank rather than a distributed ledger. And so this allows for more effective monetary policy, and for China's purposes, it's much more increased monitoring. In China, the currency is known as DCEP, so the Digital Currency Electronic Platform, and it's controlled by the People's Bank of China. China's been silent on the official launch date, but the testing appears to be quite advanced. This project is investigating the expectations of cross-border use of DCEP. At the moment, the testing procedures is just looking at domestic testing, but there is this big expectation this is going to be extended to cross-border trade. And if this is the case, what is going to be the impact on the use of US dollars as the primary trade currency, and therefore whether or not this is going to impact the internationalisation of the renminbi. Now, this is very early stage project. We only just received funding just recently, so looking forward to talking to you about how this project is going to be set up, and maybe I'll come back to a future showcase to discuss the findings. So as you can see from this slide, there's actually quite advanced in the mobile interface, and this mobile interface you see here looks quite similar to the other digital wallets that are used in China, like Alipay and WeChat Pay. So all a user would need to do after the testing is obviously completed would be download this digital wallet, and there'd be a one-to-one conversion between the existing renminbi and the digital currency. So the big question is In a country that already operates almost as a cashless society, is DCEP actually going to make any difference to the average transaction? Well, for the individual person, probably no, except for the fact that there is this increase in the ability to transact offline. So there's a double offline transaction, which actually allows users to either receive or send money, digital currency, without the use of the internet or a mobile network. So then what's the objective? Why is China actually trying to go ahead with this? Is it for more effective monetary policy? Is it to be the first? Is it to have control? I'd say all of these were pretty important considerations. However, I think a secondary issue, or perhaps even a sleeper objective, is the internationalisation of the renminbi. DCEP will not only make transactions in domestic transactions much more efficient, but it will also simplify cross-border transactions and provide an impetus for the wider use of the Chinese currency. So the internationalisation of the renminbi has been a really important policy agenda for China over the last decade. A number of significant advances since the opening up of the current account in 2009, and the liberalisation process has proceeded quite effectively. It slowed a little recently. I think up to about 2017 it was quite strong, and you saw a lot of opening up of the debt and equity markets to foreign investments, and the inclusion of the renminbi and the IMF currency basket, the SDR. These are really important implications for both the internationalisation of the currency, but also the internationalisation of the Chinese economy. But as you can see from this graph, there's significant ground to cover. Here we've got China listed as fifth in this is from June 2020, fifth in the use of global payments. But this is obviously not a linear scale, where you've got China sitting at 1.76% and 40% is covered by the US dollar. So considerable amount of ground to cover. But that doesn't mean that it's not a target, given that China's number one trade nation, would go to follow that at some point the transactions that are traded, trade transactions that are done at the moment in US dollars would move to renminbi. And this may be quite swift. One of the things we've been looking at is the use of renminbi in the Belt and Road Initiative. So the projects that have been funded under the Belt and Road Initiative at the moment are funded in US dollars, mostly in US dollars, only about 14% of them in renminbi. So you can actually see that this would be a likely move if they're moving forward with the pilot program. So how are we going to approach this? We're looking at a very mixed methods approach. So we're looking at semi-structured interviews of both Australian and Chinese trade and investment stakeholders. So we're looking at the actual firms that are trading with each other, plus the official sector, financial services, the big Chinese banks. We will then use a broader survey instrument to pick up sort of wider metrics on the expectations of what's going to happen with the Chinese currency, especially in the digital form. And we're going to then pick up both absolute and relative measures of expectations, opportunities, risks, concerns, and the like. And then we're going to workshop this across, well, if we can physically, across China and the US. Perhaps it'll be done digitally, which would be rather appropriate with the currency. What are the complications? Well, obviously COVID could be a big one, and not the way you think. Prior to COVID, the growth rate of China compared to the growth rate of the US was you're going to see China overtake as the largest economy at some point in the future. With differential reactions to recovery rates from COVID, this actually might happen more quickly than originally expected. So if that's the case, then you might see the drive to the use of renminbi more from the growth rates of the different currency rather than specifically from the DCEP itself. We've also got the issue with the unrest in Hong Kong. Hong Kong's the gateway to China as far as transactions goes, and certainly the financial markets. Future unrest in Hong Kong could see China sort of pulling back on some of the capital liberalisation policies, and also pulling some of the transactions back into China itself, perhaps through the Shanghai Free Trade Zone. And speaking of political unrest, you can't actually talk about China without talking about Trump and the like. So there's obviously an escalating tension between US and China. And you see in the US, for example, WeChat's already been caught up in a TikTok saga in the US. And so wide adoption of a digital currency coming out of China could actually be seen as a security risk. So just as technology has disrupted business, media and politics, so digital renminbi could also disrupt the US dominance as a reserve currency. Inertia has got a lot to play when it comes to the decision on trade currency settlement. So a not so subtle push from China using this DCEP as a platform could actually have significant implications for the internationalisation of the renminbi. Thank you very much, and I appreciate your feedback.
Excellent. Thank you very much, Kathy. And I'm handing it straight over to Nathan, who seems to be at his Sydney office at Morgan Stanley.
Thank you for that breakdown of your study, Kathy. I think there's a couple of things I can just sort of chuck in right away. The first one is you made the comment about at some point China will overtake the U.S. in terms of economic size. At the firm, we think that that's going to happen sometime before the end of 2030 at the absolute latest. You're right with the way that the COVID-19 is evolving. It is our view is that the emerging markets are going to lead the recovery again. We don't see DM coming back to pre-COVID levels for at least 2 years, whereas for the U.S., for the emerging markets, including China primarily, that's going to happen a lot sooner. So that gap to the U.S. is going to close. There was one aspect about your study that I think it seems a bit of something that seems unaddressed, and that's really around this idea of a trust deficit. One thing that I observe as sort of a practitioner is that whenever something bad happens in the world and there's chaos, or in the case most recently where you got the COVID-19 sell-off, there's always a huge flight to quality, and that means by definition the purchase of U.S. treasuries. And so there's a real perception that if bad things happen, run to America, right? And so, so one thing I'm just I want to sort of challenge you on is that while you may have the policy to encourage the use of the currency, to use currency globally, you got to bring the market along on the journey with you. And Gerhard, if you don't mind, I have this is a chart that I put together. Like, I apologize, this is really, really basic. I literally just threw this together in a few minutes, but I'm hoping it sort of illustrates my point. So this is just using World Bank data. And what we're looking at here in the first chart, at the very top of that chart, is the percentage of global GDP. And you look at 1999 versus 2019, and you look down those columns, you see that the US is actually, as a percentage of global GDP, has actually gone from 30% of the world GDP to 24%. Alternatively, when you look at China, it's gone from 3 to 16, right? There's been a big change there. Then we look down further and let's look at dollars. So these are all, of course, expressed in US dollars in real terms. You can see that the world economy grew by $55 trillion, or 169%. And the bulk of that growth, again, in dollar terms, can really be seen in the US and in China in particular. In fact, the China grew more in dollar terms than the US did over the last 20 years. But here's the thing, right? So let's look at that last chart at the bottom, just bringing together your data and my data. As a percentage of GDP, the US is 24%, but they represent 40% of global currency usage. China, which is becoming increasingly more important to the world, where everybody knows that they're going to be the biggest economy in the world. Everybody knows you're going to have to deal with them, but yet they only represent less than 2% of currency usage. And I would suggest to you that part of that is this trust deficit. So another element of your study, talking about how digital makes things easier, well, it also makes it easier for control. And what I worry as a foreigner, that if I were to start holding material amounts of yuan, what would stop the Chinese one day, for whatever reason, deciding that Australians, you need to be punished, and we're going to freeze your currency. Literally, we're not going to let you be able to transact it because the technology simply makes it that easy. That's the great advantage of blockchain, is that you can identify something right down to the penny, and you can very easily just switch off all Australian holders of that currency. You're not allowed to transact, and suddenly you're person non grata. What stops the Chinese from doing that? And I think it is those social issues as well, those governance issues, that need to be addressed before we can really make the argument that China is going to see its share of currency usage move from that 2 to something a bit more meaningful or more representative of their place in the global economy.
Yeah, I completely agree with that. I think one of the biggest issues is not access to China, it's confidence in China. And when you're talking about the digital currency, even prior to that, when you're looking at just the transactions in renminbi, I mean, the transactions between Australia and China, I mean, they're a number one trading partner, number one destination for exports, number one source of imports, but our transactions in renminbi are somewhere around the 2% level. just between the two countries. And we did a research report a few years ago, and we actually did a bit of a survey on transactions and what the settlement was in different currencies. And confidence and security issues and trust were big factors in that. So that's something we definitely will be exploring in this. We did find that a lot of the companies, even the big sort of iron ore companies, which are US dollar balance sheet companies, were still testing the groundwork. They had a couple of trades in renminbi. It was almost like they were testing their system to say, if we were forced to transact in renminbi, we would, but I can't see them wanting to actually leap across and do it for all the reasons you mentioned. The other thing is, from Australia's point of view, even if it's a trust issue, most of our trade with China is we sell to or we buy from. There's not a lot of both sides of the balance sheet type of trade. So there's no real need for anyone to hold on to renminbi. It's really quite a fungible currency. So for many transactions, even if it was digital, I would expect that you would see Australian firms jumping into the currency, doing the trade, then jumping straight out of the currency again. So maybe that would alleviate the trust issues. But I completely agree with you that the trust in the Chinese government, especially in Australia, the media is not much help, is at an all-time low. Diplomatic relations are at an all-time low. And these concerns around mixing economics and politics and trade are real concerns. And I think that this is something that I'm not sure where the direction will be, but hopefully the research will uncover some of these concerns and perhaps solutions for them.
Thank you, Kathy. We have a couple of audience questions that I would like to put in the round here for maybe you and Nathan. The first one is from Desiree from MSCI, and the question was, Hong Kong's new security laws impact China on the global stage and will also impact its currency, ?
I think that comes back to exactly what Nathan was saying. This is the trust being sort of eradicated. If you've got these new security laws that are imposing what used to be their free market sitting within China, then and sort of imposing those now seems like a fairly assertive step, and that would not be considered very well from the financial market. So it certainly would be a consideration and an impacting factor on it.
And we have a second question from Joan, and this is centered around what is the effect of Libra being the permission blockchain proposed by American social media company Facebook?
I think the difference with Libra is it's yet another cryptocurrency. The difference with DSAP, it's a central bank currency. Yeah. So while one is the ability to trade in a digital way, and certainly you make an investment as if it was an asset, well, that's questionable whether it's an asset or not. This is actually indifferent. There's no difference between the paper money renminbi and the digital version DSAP. And so there's that one-to-one trade. And I think that makes it quite a different type of animal, that you don't have this distributed ledger for the blockchain. You actually have it controlled by the central bank, which has both positive and negative effects. It's great for monetary policy in China. There's very little credit card penetration because point of sales went from pretty much cash directly to mobile wallets. They sort of jumped over that whole process of credit card penetration. So trying to actually control monetary policy without that link through credit cards is quite a difficult thing to do. But if you can manage it through a digital currency, then it's much more effective, which comes with control as well as better monetary policy. But there's also really good concerns around, recommendations around anti-money laundering and the like. So it's quite a different type of currency than something like the Libra.
Yeah, I'd only add to that Libra is trying to be a universal currency, and this gets into issues of sovereignty, and no country is going to want to surrender that. And as to your point about money laundering and a lot of these sort of regulations, I think that already is already creating a lot of headaches to implement Libra. I think where the Chinese have it right is that they are doing it from the central bank. It is their currency, and they're not trying to pretend it. They're not trying to pretend it's someone else's. But just as sort of as a left field thought, I think this sort of I think a lot of people forget about one other major difference between paper currency and digital currency is that one requires electricity. And if you've ever spent any time in the emerging markets or ever gone through a blackout, you'd know what it's like to not have electricity. I think a lot of people take that for granted, and have this in an environment where you're looking for something that is a store of value and has got real stability to it. the practical considerations of what happens when you need to actually pay something and you can't do it, and in an emergency, paper money seems to really work quite well.
So thank you very much.
I think the difference, though, in China is that, sorry, just real quick, is that it's already a cashless society. I jumped in a taxi, well, when I was in Wuhan in November, which is a different story, and I was in a taxi with a student, and I went to pay with cash, and she was like, "Oh, I'm not sure he'll take it." Like, no one takes cash. Even people begging in the street will have a QR code for you to use. So this is a country that's already completely digital. The step for them is not going to be so great, but for the rest of the world, definitely so.
Thank you so much, Kathy and Nathan. And our next presenter is Dr. Diego Puente Moncay, who joined the UTS Finance Department earlier this year.
Okay, thanks, Gerhard, and good afternoon, everyone. First of all, let me start by saying it's really a pleasure to be part of this event and have the opportunity to share part of my work with all of you. Now, this research is titled "The Facto Bank Bailouts" and is joint work with Fong No from the ANU. Now, here Fong and I investigate the influence the US government has over the IMF loan decisions. And in particular, our story here is that a country, usually a developing country, experiencing a sovereign debt crisis has higher chances of getting an IMF loan if US banks are directly exposed to that country's foreign debt. And we refer to this as this type of assistance the US offers to its local banks as a de facto bailout. Okay, so now the influence the US has over the IMF has been documented extensively. In fact, research shows that countries that are either politically or economically close to the US receive larger loans and more frequent loans from the IMF. And this influence stems from the fact that, as you can see in this graph, the US is the country with by far the largest voting share in the IMF. So this puts the US in a position to influence IMF decisions and direct IMF loans to developing countries for reasons not necessarily linked to the actual economic needs of the countries receiving these loans. Now, this headline here exemplifies this influence quite well. Now, this is from the special report by the New York Times back in 1998. And this provides astonishing details about how US Treasury officials had pressed the IMF to provide one of the largest IMF loans in history to Russia during the Russian financial crisis. Now, how is this all connected to our claim of de facto bailouts? Well, from the government's perspective, helping banks directly is extremely costly. On the one hand, bank bailouts come at a high fiscal cost, but in addition, using taxpayer money to bail out banks is never a popular decision. So the political cost of direct bailouts is also quite high. So given this cost, US politicians have great incentive to use their influence in the IMF to assist US banks when these are exposed to significant losses from a sovereign default. Now I say significant losses here because US banks' exposures overseas can be quite large. So for instance, during the early 1990s, US banks' total foreign exposure was more than 100% of the total capital. And although the foreign exposure has reduced in recent times, still sits at around 20% of the capital. So given these large foreign exposures, there is great incentive for the US to allow those countries experiencing a sovereign debt crisis access to IMF funding, especially when that funding can then be used to repay any external debt overdue. Now, so Fong and I gathered data from many different sources, and we measured the yearly foreign exposure of US banks to a sample of 47 developing countries. And then we estimated that whenever these countries experience a sovereign debt crisis, the chances of receiving an IMF loan increased significantly with the level of US banks' exposure to that country, even after accounting for the level of political and economic relationship between these countries and the US. And in addition, we found that this effect was stronger exactly around the time when helping US banks directly was politically and fiscally costly, like during election years or during years where the US was running a large deficit, which is aligned with our claim about the US using its influence in the IMF as an indirect way to help troubled banks and at the same time minimize fiscal and political costs. Now, let me quickly go through two additional findings we believe are quite interesting here. The first is about the voting patterns of members of the US Congress whenever they're asked to vote to support funding increases for the IMF. So funding increases for the IMF usually expand the IMF capacity to lend money to countries in crisis. So we take a vote in favor of an increase in IMF funding as a vote in favor of what we call the Facto bailouts. And one of the most important variables that explains why members of Congress vote in favor of increasing the IMF funding is actually the campaign contributions they receive from the finance industry, and in particular banks. So we interpret this as evidence of how responsive US politicians are to the pressure and to the influence from the banking lobby in supporting these de facto bailouts. Now, lastly, we also confirm that US banks do indeed benefit from IMF loans by showing that those US banks exposed to a country in a sovereign debt crisis experience an average 5% abnormal return. So the stock price goes up at around the time when an IMF loan for that country is announced. So to conclude, overall, with this research, we believe we're identifying an alternative mechanism through which the US government, in this case, can backstop the losses of large banks while at the same time reduce the high political and economic costs normally associated with direct bailouts. All right, so thank you very much for your time and thanks for listening.
Thank you very much, Diego, and I'll hand it over to Nathan to provide his commentary.
Hey, Diego, that was a good piece of work, actually, and it's actually, of the three speakers today, it actually dovetails into some work that Morgan Stanley is doing exactly around a topic similar to what you're talking about, though it's more of an extension and just a recognition of the factors that you're identifying. And the idea here is that as a firm, there's this, for a very, very long time, the world has been in sort of what we call the unipolar world, where there was this idea of a Washington consensus and that the globe was converging around a single political, economic, and social narrative, basically around America, right? But what we've seen more recently, and I think this is probably where your research is going to be going, is going to maybe start feeling some challenges using it going forward, is that our view is that we're moving from a unipolar world to a multipolar world, one where the US and China, they're not necessarily decoupling, but they're really more about disassociating, and they're really starting to compete in multiple spheres. Things like technology, security, health, financial markets, corporate governance even, like what's the right way to run a company. And what's caught in between are Europe, Japan, and the rest of the world, who are all trying to basically find a balancing act between influencing the direction of policy and at the same time looking for economic activity. And of course, intermingled with all this further is our concept that we're throwing out there called globalization, that one of the key outcomes for corporates in all this is that globalization is going to slow down, maybe even reverse in selective areas as revenue mixes change, as supply chains get reassessed, as that risk reward sort of favors more localization versus a globalization. So I think the link here between the work that you've identified here, which is quite interesting, because I've never seen anybody actually put a dollar or probability around the data. I think one of the challenges about using this going forward is that we're definitely moving away from a world where the U.S. is going to be able to flex its muscles, as you sort of alluded to in your report, and are going to be facing a lot more pressure to against another sort of big kid on the block, i.e. China, and at the same time try to get other partners involved. Just as a final point, just as and I think Kathy was sort of touching on this earlier. Look at Australia. Well, we're really getting squeezed between China and America. America, obviously, because of our strong historical and military ties, and in that respect. But in the same time, China is our largest trade partner and the biggest driver of our economy. You got one side where we were supporting global investigations into COVID-19. We were criticizing the Chinese on the detention of the Uyghur people. We've been very vocal around the actions that China has taken in Hong Kong. The flip side to that is now suddenly we face 80% tariffs on barley into China. Our beef has been banned, and now the Chinese overnight are starting an anti-dumping review into Australian wine. So it is a very interesting situation where, yes, I would agree that perhaps the Americans have flexed their muscle, but I think it's going to get a lot more complex going forward, as there's going to be another kid on the block, and then all the other kids are no longer going to be thinking, well, the answer is always to go left, but now you may actually have to think about going left and right.
Yeah, thanks, Nathan. Thanks for those comments. I think you are completely right. And in a sense, what we're doing right now is documented what happened in the past, basically. But you're right. This is probably going to change, and we saw that already back in 2015. The IMF, or the voting share of China, increased in the IMF as well. So it wasn't the second largest country back then, and it became the second largest country by voting share back in 2015, because China started pressuring the IMF to increase its voting share as well. So we're seeing that already.
If you really want to get into it, there's actually a really big debate about how they actually measure the GDP. I think it was actually around, I'm sorry, I can't remember the exact day, but if you look at the history, you'll see that the purchasing power parity calculation, the one that normalizes and tries to make for a more even comparison of GDP, the methodology got revised about a week after China became the biggest economy in the world on a PPP basis. So there is if you really want to talk about the invisible hand or men in black suits walking around, there is definitely a bit of that going on as well.
Thanks for the insight.
Thank you, Nathan, and thank you, Diego. A couple of questions here. The first question block is kind of circling around geography and maybe size of loans. Diego, I'll start with you regarding your research. Is this effect unique to the US you're describing there? Are there other countries that also use their voting power to influence the IMF lending decisions? That's kind of the geography question. And allow me to tag on a second one in the interest of time. In addition to increasing the probability of receiving an IMF loan, is the size of the loan also influenced by the exposure US banks have to countries receiving the loan?
Yeah, thanks for the questions. And I'm going to start with the last one. And yes, we also look at the size of these loans, and we observe that size also matters when it comes to when it comes to the fact that US banks are exposed to a particular country, and then the country suffers a sovereign debt crisis. The size of the loan also is going to be higher, according to our data, when you have that US exposure. And in regards to the first question, that was the natural step for us, right? So we started with this idea, started exploring what happens to the US, because it's the largest country by voting share. But then we also explored other countries, like especially the European Union, and we didn't find the same results, right? So it is, in our data at least, it is unique to this effect is unique to the US.
And Diego, an attached question, and I'm not sure if that also touches what Morgan Stanley is doing in their research. Over 100 countries have approached the IMF to access emergency financing instruments. This isn't just a low-income country problem. Do you think this debt threatens a global development emergency? And is there a justification for the several calls for debt standstills to ease the burden on developing countries? It's kind of a policy question rather, and very international.
Yes, I think it's a very important question. Coming from a country, my background is from Ecuador, so I understand what the question is where the question is going. And Ecuador is one of those countries that are asking for help to the IMF and other international organizations, especially right now in the midst of this pandemic. So I would support any calls for alleviating the debt burden of countries like developing countries like Ecuador. That's for sure. But it's not really something that I've been studying or researching lately.
Thank you, Diego. Maybe something for future research. Nathan, anything to add to that? Or
you're absolutely right. The amount of debt sort of floating around the world, if you look at it from an aggregate basis, is becoming quite shocking. But remember, a lot of that debt has been sort of nationalized. It's really been about balance sheet expansion occurring in the developed markets. So arguably there is a lot of also corporate debt floating around out there as well. But I think at the end of the day, if there's one thing that gives us a lot of comfort at this point in time, I'm not saying this will happen forever, but at least at this point in time, we just look at rates and we look at long-term rates, and long-term rates are sitting at all-time lows, and the market is basically saying we're relaxed about it at this point in time. The irony is that with rates so low, it actually makes it very affordable to have all this debt. The only issue, the broader issue though, if you want to sort of take the second derivative, is that it does sort of highlight once again just how addicted the world is to cheap financing, that to get any sort of GDP growth, we increasingly have to use more and more debt to try and pry out that growth. So there are imbalances. From an investor's point of view, I think that from a day-to-day and a mom and dad sort of perspective, the key message that we have is that within all these different factors, it does sort of mean that returns are going to be lower. That's the bottom line. We're in an environment now where you have that bull market that you had in fixed income over the last 20 years basically end, like when rates got to zero. So your portfolios going forward are going to be facing an environment of lower returns. You're not going to get that equity kicker that you got out of your fixed income allocation like you did the last 20 years.
Thank you, Nathan, very much. Diego, thanks for your fascinating research. Our last presenter today is finance researcher Anirudh Dhawan, who is a rising finance research expert at UTS. Over the last years, Anirudh has worked closely with Professor Tallis Putnams, and today he presents Getting Burned by Frictionless Financial Markets.
Thank you, Gerhard, for the introduction. And I'm glad to be given this opportunity to present today. So the paper that I'll be presenting is joint work with Tallis Putnams and Marco Navone here at UTS, and Benny Luce, who's now at Munich. In this paper, we examine whether we can make some structural changes to stock markets to help retail investors make better investment decisions. So this is actually quite a topical issue, because during this lockdown, retail investors in Australia and throughout the world have flocked to stock markets and put tons of money and are essentially using these venues as alternative areas of gambling by betting big on stocks of bankrupt companies rebounding. So for anyone who does not know, a retail investor is an amateur individual investor who's trading on their own accounts. It's a well-known fact that these guys lose a lot of money in markets and they consistently underperform the market portfolio. And we think that the frictionless nature of markets today is actually a contributing factor to this. So frictionless market is one where people can trade cheaply, quickly, and easily. And this is what is considered the desired ideal in today's time. So I've included here 3 examples of retail brokers advertising features of their platforms that make trading cheap, easy, and quick. We think that there might be some frictions which can actually make trading harder, fine, but they also have a desired effect of actually reducing impulsive decisions made by retail traders and thus helping them lose less money. So what do I mean by impulsive decisions? Well, I think I've got the cartoon here is actually a nice illustration of that. In this case, it's probably rash to sell the stock snow just because snow is falling outside. And if this guy was living in a frictionless world, all he would have to do is say, Alexa, sell snow, and that's it. His trade would be executed. But if he was living in a world with some more frictions, he might actually have to call his broker, maybe even explain to the broker why he thinks this trade is a good idea. And in doing so, he might actually end up thinking more about this trading decision and even realizing that it might be a silly thing to do and might eventually just back out of this decision entirely. So some frictions can actually be the reason behind some knee-jerk reactions like this not ending up as bad trades. So in our study, what we do is we conduct a lab experiment in which people participate in a simplified version of a stock market. And then we individually add different frictions and see what effect these frictions have on investor behavior. So we have 3 frictions: high transaction costs, forced time delays before orders. So here we just make people wait for a certain period of time before they're allowed to place orders. And we also ask them a question relating to the stock's value before they're allowed to place an order. So this question is very simple. It's just, what do you think the stock's value is? What we find is that the high transaction cost friction is pretty useless. It does not really help impulsiveness or performance. The waiting period friction is a bit better in that it helps reduce impulsiveness, but it's still not, it doesn't get the job done because it really doesn't help improve performance of investors. But the last friction, the question that we ask, is actually pretty good because it helps reduce impulsiveness and also improves performance for the worst of investors. So these are the guys who are actually performing the worst in our trading group. And these guys actually start performing a little less worse as a result of this friction. Clearly, just reducing impulsiveness is not enough, right? Because even the slow friction reduces impulsiveness, but that does not really help anyone lose less money. So what makes a friction effective? Well, we think that to be effective, a friction needs to not only make people think harder about their trading decision, but it also must make traders approach the trading decision in the right manner. So based on this explanation, the worst of investors, so the guys who are actually benefiting from the task friction, in the absence of frictions, these guys are approaching the trading decision in the wrong manner. And this is what is causing them to lose out. So what I mean by this is that they are focusing too much on the price of an asset because it is more noticeable and they see it very easily. And in doing so, they're ignoring the asset's core value and the core value formation process because it's less noticeable. Now, the task friction, by asking them about what they think of the asset's value, is actually directing their attention to the asset's value, and it's helping them approach the trading decision in the right manner with the asset's value in mind. The slow friction is not doing anything of this sort, and that's why these guys are probably still approaching the decision in the wrong manner in the slow friction, and that's why the slow friction does not really help them perform better, whereas the task friction does. And yes, that's what we think is the key to explaining what makes a friction work. And just to summarize quickly, in our study, we find that a friction can help investors perform better if investors are ignoring some important information that they can easily miss out. And the friction can actually help direct the investors' attention to this information. Thank you.
Thank you very much, Anirudh, and I'm handing it over straight to Nathan for commentary.
Thanks, Anirudh. That was actually when I was looking through the three presentations today, I thought yours was quite intriguing, and I've come to the realization that what you're doing is actually taking a different tack on education and financial literacy. Really, the idea that retail investors kind of get bullied when they go into the market, and perhaps they really need to be thinking more about what they're doing. When you mentioned at the beginning that people are treating it like gambling, yeah, I hate to use that expression, but it does feel like that in some ways, where people are just sort of leaving things a chance, and they're just sort of looking at it as a game as opposed to what it really is, and it's about a source of capital that can be used to try and generate more wealth. And it's actually a mechanism that is very important in society that actually has real value and is about allocating resources efficiently. It's not a, if you want to gamble, go to the casino sort of thing, right? I think the other aspect that I would include in your report is that for me as an investor, you're absolutely right. Don't rush. I've been a fund manager for much of my career, and I can tell you the worst decisions I've ever made are the ones that I rushed, the ones that I didn't stick to the plan, the ones that I didn't stick to my methodology. I kind of went with my heart as opposed to my head. And inevitably, though, that's always the wrong thing to do. You really need to be thinking about things rationally. You need to be having a methodology. You really do need to look at the totality of the circumstances, and that includes ESG and other sort of financial factors as well. I guess the other thing I would sort of add to your report, it might be something interesting to mention. A lot of these Robinhood traders, or these day traders, or a lot of these platforms that offer zero brokerage, don't think this is a big charitable event, or don't think that these guys are not making any money doing this. The reason why they're able to do that is that they're selling the flows to market makers. So they actually are incentivized to try and attract as much transaction volume onto their platform, because that's the value to them that they can then on-sell to the market. And I think that's probably another element to this that, again, as practitioners and as users, need to understand that this is another sort of headwind to creating wealth. the simple definition is that someone else is putting their teeth into the pie and eating quietly out the side. So a lot of these sort of platforms in one way reduce friction, but in other ways actually add to the competition for capital in the market, right? So I applaud the work. I think it's another way of trying to encourage unsophisticated investors to get a financial advisor. I think that's from our perspective, you've exactly hit the nail on the head that yes, we're all busy. Yes, we can't be experts in everything. And this is why it's important to have a trusted financial advisor. So I think you're absolutely right. The system does need friction. Sometimes you can drive too fast. I wouldn't put a L plate into an F1. There's a reason why you don't do that.
Yeah, I was just going to thank Nathan for his comments. I do agree with all the points that you make.
Thank you very much, Nathan, for connecting Anirudh's research to the commercial reality of finance. Anirudh, a couple of questions that come in. First of all, there's an interest in would the friction be as effective in the real world when you take it out of the lab? Your results pertain to lab environments. Can you shed light on how applicable this is in real life finance?
So yeah, that's a good question. I'm not so I can't say for sure how the friction, what effect the friction would have in the real world. Probably because, the lab setting is a bit more of a controlled setting. So sometimes you have higher magnitudes in the lab settings and things are a lot more complicated in the real world. But I think definitely there would be some effect because the phenomenon that retail investors consistently ignore some information because it's difficult to catch is present in the real world as well, and this is well documented. And if there is a friction that can actually help direct their attention to this information, then it would at least have some benefit to them in terms of in terms of reducing the losses that they have.
Thank you, Anirudh. And another question related to maybe you used the word magnitude. What is the magnitude of the performance benefit provided by the friction for the worst of investors? Can you quantify that a bit? Give us an idea of what we're talking about.
Yeah, so in our last, in the task treatment, the one where we ask a question, the magnitude is around 50%. So the guys who are, if they are losing $1,000 in the absence of frictions, they end up losing only $500 with the task friction in them.
Great, thank you, Anirudh. We have now come to an end and we're conscious of our audiences and also our guests' time. We are now close of today's event. We thank all researchers and of course Nathan Lim from Morgan Stanley for their presentations and commentary, and also Associate Dean Research, Professor Baddeley, for her introduction. Welcome. Thank you very much on behalf of the Finance Department. Importantly, we hope that you, the members of the audience, enjoyed the engagement with fresh finance research. Please don't be a stranger. Stay in touch and follow us on LinkedIn and Twitter to learn about upcoming events. You can also catch up with past events on demand in our growing YouTube channel by searching for UTS Finance, and we will also put this event into that channel. And as always, email us with feedback and ideas using the email address engagement-finance@uts.edu.au, or contact the researchers that presented today directly to provide feedback or maybe additional inspiration for their research. Have a great rest of the day, stay safe, and we will see you all at our next event. Thank you very much for attending.